Hey there, welcome back to the channel. Have you ever found yourself pondering about how much money you would actually need in stocks to retire comfortably? Well, today we are diving into that exact question. Can 200,000 US dollars in stocks retire you? So let's kick things off by introducing the concept of using $200,000 in stocks as a retirement strategy. It might sound like a significant amount, but is it really enough to sustain you through the golden years? Now, let's talk about the challenges and risks that are associated with relying solely on 200,000 in stocks for retirement first. Now, number one, there could be market fluctuations. Markets don't always go up all the time. Sometimes they can go up and down. And even if you're invested in the stock market, that means it can drop to as much as 40, 50%, 30%. Right, so that means the value of your security can possibly have a drawdown in that case. So if you are solely invested in stocks, that can hit your portfolio, right? Now there could be inflation, that is an increase in price. In Canada, as of April 2024, it was 3%. That means your money can lose value over time. Number two, there can be unexpected expenses. For example, people can fall sick. That's something that's difficult to predict, but in countries like Canada, you are fortunate that we have universal healthcare system, but in the US and in other parts of the world, there can still be some complications that can increase significantly that bill. Now, there can be a lot of other unexpected things that can happen and pose a threat to this seemingly solid plan. But in some cases, some people may decide to say, well, I'm going to retire at this amount. Let's say, as I will show you, you can get $3,400 Canadian dollars if you invest in some securities, right, per month. But you can then choose to decide to go and live in a country that has a lower cost of living and get other means, as I will explain, to just make sure that you are safe, like healthcare insurance, etc. But in Canada, where I live, for example, it is quite expensive to live here. For example, the average rent here is $2,300 in my neighborhood for a 3-bedroom house in British Columbia. Now, there can be other expenses, so this might be interesting, but I'm just going to use the data to just break things down. But let's not jump into conclusion yet. We need to explore the potential growth of that income. So what some people can possibly do is that they can invest in very fundamentally strong companies, individual companies, or exchange traded funds. In other words, the funds that track certain index funds like S&P 500, but then they have a basket or a number of other stocks that are in that particular security or ETF. For example, SPY, it has 500 companies that are mostly large capitalized companies in the US. So now what this means is that now if you invest your money in that particular ETF, you have exposure in different sectors. Now here comes the moment of truth. Can 200,000 realistically retire you? I will review whether this amount can be enough. Now let's look at this chart here. I have chosen 4 securities, that is JP Morgan stocks, Apple stock, SPY ETF, and HMAX ETF. But these are just examples that I'm using, but the data that I'm using here is currently latest, and I have checked this data. And what happens is this is not investment advice, but I'm just using this for illustrative purposes. So you can see on this table that there's the trailing dividend yield. In other words, you can get some cash payments. It can be monthly, for example, for HMAX, right? Every month you get a dividend. Now, let's break it down. For JP Morgan, if you have 200,000 right now at current price of $198.11, you could get 1,010 shares. And for the current dividend yield, it means one share, using the latest data, 1 year you could get $4.60 in one share, but this can change anytime. So it means for the whole year, if you have this 1,010 shares, you can get 4,646 plus the capital appreciation. Historically, JP Morgan shares have been going up. You can see that the trailing return on equity has been 16.15%, which is very high. In other words, the money compounds almost at that rate. Now, if you invest your money, all your money in Apple, 200,000, you would get 1,051 shares, and their current quarterly dividend, they increased it from 24 cents to 25 cents. So that means per year, if they don't change this, it could be $1 per share. And you would then multiply this by the number of shares that you can buy at current price if you buy all at once. So the current price for Apple today was trading at $190.29. But that means at the end of the year, you would have 1,051 plus capital appreciation. But is this enough? Let's see now, if you invest in SPY, which is a diversified exchange traded fund, you could get a dividend yield of 1.28%. But also what this means, one share for SPY has been trading at $526.10 today on 29 March 2024. And you would, let's say, using the data that I saw, the most recent data for the historical dividend yield per year, you would get $6.72. Now, what this means for the whole year, for 200,000, you could get the dividends of $2,553.60 plus the dividend yield, but it can go up and down. So that means this is just cash that is hitting your bank account every 3 months. Now, let's see this. I found this interesting. And of course, there could be other stocks or ETFs that offer high yielding percentages, but HMAX, it's offered by Hamilton. It's actually a Canadian-based company, and what they do, they write covered calls. So the first thing is, for $200 US, I convert it to Canadian dollars, right? And then I could buy at this price 20,276 shares at the price of $13.53. That is at today's price. So what this means is, if they they keep the dividend yield at 15.21%, that means one share I would get $2.04 per year, right? But they pay out monthly, at least from what I've seen on their website. That means the whole year I could get 41,366. That is just a dividend, but the trade-off is that the share value does not go up because they are just using covered calls. Basically what it means is, you own shares and then you open a position by selling the shares, and you get paid for doing that. In other words, if it remains in a certain region. So it's a strategy, covered call strategy, but you have to own the shares first and then you use that strategy. In conclusion, let's summarize the main points we have discussed. You can see that HMAX actually offers, in this case, $3,446.92 monthly at these current assumptions, right? But dividend yields can change anytime. But at least investing in stocks that can appreciate over time, they can also have capital appreciation. But bear in mind that the stock market, it can be volatile. Let's say you are fully invested in Apple. It can drop by 10, 15%, right? Or even 20, 30%, or go to zero potentially. But now, let's say if you're invested in S&P 500, it is diversified. It can not go to zero if only maybe one stock, maybe Microsoft, which is, let's say, 7% of the whole portfolio, drops to zero. Still, that means the risk is lower. But also now, in most cases, in this case, the return might be lower than investing in some individual companies. Now, so what I can tell here in conclusion is that each of these strategies can come with limitations and other advantages. But the thing is, you can see what is possible and what is not possible. And some people, they have a mix to say if they want to have more dividend focused, but they can still have other diversified portfolios and have other non-correlated securities with the stocks, such as gold, bonds, to say if the stock market drops today, they can still go up, which can help to maintain the return or the capital appreciation. Because imagine this, if Apple drops by 50%, 60%, it's highly likely, in my view, for them to continue paying out dividends, right? And of course, depending on why it has fallen down. So you can potentially lose money by investing in one stock just because you want dividends. So I thought I would just share these things with you, but also other things is I can consider is moving out to other countries that have a cheaper cost of living, but the quality of life might not be as good as in Canada or other developed countries. So it's just a trade-off, right? So it's up to an individual. Retirement is very personal, but I just thought I would just share this data with you so that you can see what can be possible. Now, before we wrap up, I want to encourage you to share your thoughts on using stocks for retirement in the comments below. And hey, if you enjoyed this video and want more financial insights, don't forget to hit the subscribe and ring the notification bell so that you can watch some videos on this channel. Your future self will thank you for it. Thanks for watching, and I'll see you in the next one. Have a wonderful day.